Hey everybody, it's Ted Bauman here, substituting for Angela Durao, who is taking the day off today on Friday. We're recording this that you'll see on Monday. Today, on Friday, big turnaround in the stock market. We saw just a huge reversion back to the tech stocks that were doing well last year. And the buzz is that it's all about the small job numbers for last month, which means that the economy is not likely to overheat soon, which means that the Fed's not likely to raise interest rates, even though they said they're not going to do that anyway. So basically, it seems that, are we back to square one? Are we back to where we were before? So we want to talk about that today. But most importantly, I think the thing is we want to know what are the key factors that will determine where we should be investing right now. We've been talking a lot about cyclicals, value stocks, rebuilding infrastructure stocks, but who knows? Will they be able to pass an infrastructure bill? Nobody knows at this point. But let's start with a chart that shows one of the high flyers. This is the ARC Innovation ETF. You can see the blue line there. This is how it's done versus the Dow this year. And the Dow has really done better than most of the indexes this year because really most of the bullishness has been around reopening, rebuilding, and that's all about the Dow. So look at that. I mean, basically, you can see that the ARC, which is up just a couple 100% in the last 12 months or 18 months or so, is been the poor performer. So that's the backdrop. Is this all going to change? Clint, what's your take?
My take is you look at the macro variables that are in play, that caused ARC to soar, as you mentioned, and then those are at play for the rough times that ETF has fallen on here recently. But we're seeing the big bounce in tech and growth stocks today on the back of that weak payrolls number. And there's two other areas of the market, two other asset classes that I'm watching carefully that I think explains a lot of the bounce today. But then depending on how these progress, and we've got some key chart levels to watch, this will really tell you if whether or not you can see a sustained rebound in some of these high growth and tech areas of the market. So the first one is with interest rates. We talked a lot about yields earlier in the year. It's been kind of quiet on that front here recently. But as we've discussed, yields have a big impact on stock valuations, especially in the more expensive areas of the market. And so here's a chart of the 10-year Treasury yield, just recapping where we've been. You can see since August of last year, we've just been on this sustained uptrend. That increase in yields accelerated once you got to about February or so. That's when you're seeing a big chunk of that sell-off in the growth space. But over the last 2 months or so, we've really been kind of trading sideways. And what's important is if we can start to see these yields kind of break back down and turn back lower, as we've been seeing so far this morning, that'll help support the tech trade. And so with that in mind, there's one really important chart that I'm watching right here. It's Treasury futures now. I'm going to switch over to futures instead of yields. And so this is price. So when price is moving higher, that means yields are falling. And the chart I have right here, this is actually a 4-hour chart. So sometimes we use daily charts, sometimes we use weekly charts. This is actually taking intraday prices for Treasury futures because I want to narrow in on sort of that sideways trading, that consolidation that we've been seeing in the last couple of months. And what you can see is that, once again, this is as of this morning, I'm highlighting that consolidation with this green box on here. We're starting to break above that green box. So if we can see a sustained move higher here in these Treasury futures prices, that means yields are moving lower, and that can come back and help support sort of this growth in tech trade. Now, there's one other macro variable I want to mention, and I think this has also been something that's fallen off people's radars, and that's the dollar. The US dollar is incredibly important, especially for technology stocks, because the S&P tech sector, and they actually get 57% of sales from outside the US. That's the highest percent of sales of any sector that comes from outside the US. So over 50%. And basically when a tech stock, when they're making a sale in an international market, if the dollar is strengthening, those international sales are worth less in US dollar terms versus when the dollar is weakening, those international sales become worth more. So that's why the dollar is so important. And just to see where we've been, here's a chart of the dollar. And I remember at the end of 2020, everyone seemed to be expecting weakness in the dollar throughout this year. but it was quite the opposite. So with this green channel that I'm highlighting on this chart, this is the US dollar index. From the start of the year through March, we're on a pretty sustained uptrend. But just over the last month or so, we've been weakening, and we're right back down to this key $90 level. And at the same time, some gauges of momentum, so the MACD in the bottom pane had kind of reset at that zero line, is starting to roll back over. The stochastic in the middle panel of this chart got overbought. It's starting to roll over. There's a couple, so that 90 level is really key, and I'll explain that here with a couple more charts. One is just the seasonality now that comes into play. If you looked at just seasonality, you wouldn't be surprised that the dollar was doing well to start the year. So the chart I have right here, this is how the dollar on average tends to perform throughout the year. So just taking an average of what the dollar's done in all prior years and plotting that out, this is what it looks like. The vertical green bar or line, that's where we are right now. So what you can see is that we tend to see the dollar strengthen to start the year, but then really from about April all the way through September, we hit this downtrend. And so that's one thing to keep in mind as we're at this key 90 level, is that we tend to see weakness overall over the next several months. And I keep saying this 90 level, last chart I have for you right here, is taking that dollar chart back 5 years now, just to frame up the big picture of where we are at these levels. And in 2018, we were hitting right around that 89 to 90 levels. That's why I keep highlighting that. If we see this momentum roll over, if we see the seasonal weakness kick in, and we start to dip below this 89, 90 level on the dollar, that's another factor that'll come into play along with yields to support this growth tech rebound from the sell-off that we've seen so far this year.
Right. So that's one part of the mix. So, you're looking at these big picture variables. And what's interesting is that, these were really major factors in the big sell-off that we saw really starting in March this year. And I want to talk about the effects of that sell-off, how money has been moving around in the markets and what that might mean, if there is going to be a short-term reversion perhaps to some of that trade. Here's a chart that shows US equity fund flows. Now, this is primarily from institutional traders. This is the big money. This is what's been happening. I showed this in a chart earlier this week to one of our profit switch videos. But basically, if you look at the trend, it's been all downward. And the last week of April just saw one of the biggest withdrawals of funding from equities that we've ever seen. It was almost $22 billion worth of money out. Here's the next chart that shows where that money went, and essentially it went into money market accounts, which are really a cash equivalent. So it's a question of big institutional investors. They've been gradually reducing their exposure to equities, selling them to everybody else, and that's basically retail investors, as I'll show you in a moment. And that's part of the reason why we've had this weak price action. They've been taking money out, they're keeping their powder dry, and the big question is, what are they going to do with the powder next? So here's also a chart of, I think, an important indicator of retail investor activity, and this is a chart of options trading, and it's called option volume, which is essentially bets on stock going up. You can see that for most of the period of 2020, it was on a rising trend. That green line is a 50-day moving average of call options. But now you see that it's fallen off, right? So again, that's an indication that retail investors who really started liking call options a lot towards the end of last year has started to move out of that. So the question is, where's all that money going? And that's another factor behind, I think, the weakness in stocks. Here's a chart that I picked up from my regular trolling through the news, and it shows that basically the relationship between the Bloomberg cryptocurrency index and an average of a couple of stocks that had done really well last year in the technology sector. Now you see that in February, the tech stocks really hit a peak, and ever since then they have been retreating. But look who's been replacing them. It's the cryptos, right? So basically, you've got big institutional money moving out of the market, with trading volumes reducing somewhat, but the retail people taking over. But now the retail people are also pulling money out, I think. It's plausible to argue, and they're putting it into cryptos. So here is Bitcoin. One chart you can see, Bitcoin is just going absolutely nuts since the beginning of the year. Here's Dogecoin, which is the joke coin about the Japanese dog, which is not supposed to actually have any value at all. Look at it; it's going crazy. So fundamentally, the thesis here is that a lot of money started moving in particular directions based on the assumption that we were going to have higher interest rates, that we were going to have a fast rebound in the economy. And now that's all being called into question. So the question, Clint, is how do we play it?
Yeah, I think there's two things to have in mind. One is that, I think there's probably a short-term sort of a tactical trading opportunity and some of these high growth and tech areas of the market. If you want to look at something like you're showing at the beginning, the ARK Innovation ETF, ARKK, it's down 30% from its high earlier this year. And if we can start to see, some of these other variables like interest rates and the dollar come into play, that supports, once again, at least a short-term rebound in that ETF and the underlying stocks that it holds. But for longer-term investors, look, valuations still matter. And I was just looking at the median valuation in the ARK Innovation ETF this morning. The median price to sales is still a little over 18 times for its underlying holdings. That compares to just over 3 times price to sales for the S&P 500. So just framing that up. So it's, even with this big pullback, it's still very expensive relative to just a broader market index, at least. And that's why, if you wanted to still take a look at the tech space, one ETF that stands out to me is TDIV, TDIV, which is a First Trust Technology Dividend Index Fund, which is a mouthful to say, but here's a chart of how that fund's performed, how that ETF has performed this year against the NASDAQ. You can see it's up, the blue line on here, up a little over 15% compared to about 8% or so for the NASDAQ. But the reason I bring this ETF up is that the PE ratio for this fund is about 16.9 times. And that compares, so that's cheaper actually than the S&P 500. The S&P 500 is at about 23 times, the NASDAQ at about 29 times. So if you still want to get the tech exposure and you're taking a longer term viewpoint, valuations matter. And that's why I would look at something like TDIV right here.
Right. And if I'm not mistaken, TDIV specializes in technology companies that pay dividends, correct?
Correct.
Right. So basically you have the opportunity to reinvest dividends and compound. So that's a nice opportunity. So it would be companies like Microsoft, for example, that pay dividends. Right. So basically, the message is that there is a temporary reversion to the technology trade based on those job numbers. Whether that sustains or not really will depend on a lot of things. But just before everybody decides to jump back to last year's trade, I just want to show a chart that I picked up from Mark Hulbert's column on MarketWatch this morning, from the other day. And it shows a bunch of valuation metrics for the stock market. And this is, I think, basically the entire US market. It shows PE ratios, but it also shows a bunch of other valuations like the CAPE ratio, the price to dividend, price to sales, price to book. And then it shows where these current valuations are with respect to average valuations going back to 2000 and then 1970 and then 1950. And those numbers tell a pretty straightforward story. I mean, basically, we are at the very, very top of the kinds of valuations that we have seen historically. Now, that doesn't mean that they can't stay there, but the chances of them going up a lot from here would require something that has never happened before. So it just reinforces the message that you've got to be selective about what you're investing in. And Clint's recommendation to look at something like TDIV is a good example of how you can do that. Don't write off tech, find the tech that is going to pay. And that's what it's been doing this year. Anyway, that's all from us this week. We'll talk to you again next week. And of course, I'll be back on Friday with my own video. Take care. Bye-bye.